You're going to want to stick around because I'm going to talk about 7 reasons why you should consider having an allocation to the large cap traditional banks within your portfolio. Welcome to YCG, where we help your capital grow. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO here at YCG. All right, let's get into it. Point number 1, deposits. When you and I go to our local bank and make a cash deposit, those deposits across the country serve as the raw material for the bank's earning power. Did you know that since 1948, the banking industry has grown its deposits every single year, and actually at a pace faster than GDP? That's in stark contrast to every other industry out there, which shrinks as a percentage of GDP due to other players emerging, other industries coming about, technological innovation, and competitors coming into the marketplace and lowering costs. Contrary to popular belief, the banking industry has actually been profitable 83 out of the last 85 years. Astounding. And we believe that global wealth and wealth here in the United States will continue to have a rising trend. Therefore, checking that box, when we look at global champions with enduring pricing power and long-term volume growth opportunities, well, the banking industry looks quite promising in our opinion with that long-term volume growth opportunity. Now, when we talk about investing in banks, we're not talking about every single bank out there. We favor the large cap traditional banks. The top 5 banks in the United States have over $9 trillion in assets. It's astounding. We favor these large cap traditional banks because they're able to borrow money at a lower cost relative to their peers, other non-bank corporations or smaller banks. They're also well diversified geographically and different sources of revenue which strengthen their competitive advantage. This funding cost advantage comes because the government insures up to $250,000 of cash for every banking customer. 2, the industry is highly regulated, so it creates barriers to entry for other smaller banks to compete against the larger banks. 3, we also find that the large banks have an advantage because of greater security, different products that they can provide, and customers feeling better about having their money at a larger institution than at a smaller institution, even though that the smaller institutions could possibly give a higher interest rate. Number 4, we also find that many customers just find switching bank accounts arduous. And so that switching cost really gives an advantage for the bigger players with a larger deposit base. Okay, point number 2. Banks have never been in a better position right now. They are well capitalized. Due to the financial crisis in 2008, 2009, the government brought in some more regulation, forcing banks to hold more capital to prevent further losses. That being said, when you look at the financial strength of the banks right now, it's really quite strong. We favor the top 3 largest banks, which is JP Morgan Chase, Bank of America, and Wells Fargo. When you look at their asset size, they command over $7 trillion in assets. Now, we recognize that there are risks to these banks and to their balance sheets. COVID has created a whole lot of uncertainty, which has driven down the stock prices of these stocks. And yes, there could be potential future losses with regards to the loans that the banks have on their balance sheets. But again, we think they're well prepared for this uncertainty, and again, they're well capitalized, better than they have been for many, many decades. If there were to be future losses, we think the large cap traditional banks are the best prepared for those uncertain times. Another reason to look at the large banks versus the smaller banks. Another thing to remember about the large banks is that there's product diversification. They also have the capital to provide better security protection against cybersecurity, fraud, that also helps customers feel better having their money at these larger institutions. Point number 3, banks are a sticky business with very low disruption risk. which is why we believe they'll continue to earn high returns on equity. We recognize that there are risks and technology is changing the landscape. The large banks, though, aren't just sitting on their laurels. They have the financial means to develop technology and make the switching costs still more difficult for customers. If technology causes the profitability of the banks to come down, banks might be incentivized to offer higher interest rates for customers to attract or retain existing customers, reducing the profitability of the banks. But again, the banking industry is very slow to adopt new technology, and disruption risk is quite low when you compare it to other industries. Point number 4, banks have historically earned a tremendous amount of return on tangible equity, around 15 to 20%. Over a long enough time period, one would expect that the performance of the stock would mirror these tangible equity returns, particularly if you purchase these stocks at around book value. Currently, JP Chase is trading at 1.5 times, Bank of America is about 1.2 times, and Wells Fargo is trading at 0.7 times. The balance sheets of these large banks are much improved since 2008-2009. Frankly, the balance sheet of the U.S. consumer is much improved as well. Given that, we believe that these banks will generate returns far above their cost of capital over the long term. Point number 5, negative interest rates. Who would have thought we'd see that in Europe and other places around the world? That has people and investors scared to invest in the banks. Remember, the banking system is the heart of the economy. You have to have a strong banking system to have a strong economy. Yes, the profitability of the banking sector would be significantly impaired if we had a negative interest rate environment here in the United States. But I actually don't think we will have negative interest rates. Japan is a case study that many investors look to, but Japan is different than the US. Japan was very focused on imitating the technology that was coming out of the United States and then trying to do it more efficiently. And then they had to compete against Korea, Vietnam, etc., and the growth just wasn't there. Japanese banks were also incentivized by the government not to write off losses, and so they were spending tons of money keeping alive these zombie companies that really should have been written off a whole lot earlier. Now the future is very uncertain. Sure, we could have negative interest rates in the United States, but I think the Fed and the strength of the economy, we just have a lot more tools to utilize before going into that direction of negative interest rates. Remember, history doesn't often repeat itself. It rhymes, but it doesn't exactly look the same. Point number 6, the bank's valuations. Right now, the bank's valuations are super cheap relative to the market. Knowing this helps provide a cushion in case some of the risks that I've mentioned earlier come about. Banks are trading at generational lows right now and could be a buying opportunity of a lifetime. Of course, you always want to check with your financial advisor, or if you don't have one, reach out to us here at YCG. We'd love to talk to you. Just looking at the forward PE ratios of the 3 largest banks, JP Morgan, Bank of America, and Wells Fargo, it's astounding. Their forward PEs right now are trading at about 11 times earnings, JP Morgan being slightly more expensive than Bank of America and Wells Fargo. We don't pay too much attention to the forward PE ratios, but we do find them interesting, especially when you look at the S&P 500. The Cape-Shiller Index shows a valuation of about 31.7 times earnings. The average for the S&P 500, when you're looking at the Cape-Shiller Index, has been historically about 16.7 times. I like the idea of zigging when everyone's zagging. With everyone flocking to technology stocks and bidding up the valuation of these companies, I like the idea of hedging and investing a part of your investment portfolio in these large banks, especially given their attractive valuations. Point number 7, and probably the most important reason to consider owning the large US banks, is to potentially serve as an interest rate hedge. What I mean by that is everyone right now believes that interest rates are going to remain very, very low for a very, very long time. And in our opinion, the future is very uncertain. And I'm surprised at how quickly the Fed adjusts and changes their forecasts. It would not surprise me if we saw interest rates rising earlier than what people would expect. Right now, interest rates being so low is causing valuations in the stock market to go up and up. People are searching for yield and so are bidding up stock prices to get more income. People are fleeing away from bonds because they're not providing an opportunity to gain or to achieve the income that people are looking for. If interest rates were to meaningfully move up, this would dramatically cause a change in valuations in the stock market. You could see a pretty serious decline. And so owning the traditional banks actually would serve as a hedge, and in reverse, they'd actually perform very well if the environment changed and we saw a rising interest rate environment. I think you want to own a portfolio that is robust against all kinds of economic scenarios. This is why I like the idea of having a small allocation to these US banks. We think these are compelling reasons to consider owning the US large cap banks. Maybe not make it your entire portfolio, but certainly a small allocation is warranted in our opinion. Thanks for the great question today. Leave your comments below, check out our other videos, and we'll see you in the next one.